Hello everyone. Today, we are going to talk about something that is so incredibly important if you are a homeowner or are dreaming of becoming one. I'm talking about taxes. Now, I know the word tax can make your eyes glaze over, but I am telling you right now, you must be strong, you must be smart, and you must be secure in your financial knowledge. Owning a home is one of the biggest financial steps you will ever take. And with that great privilege comes great responsibility. Ignoring the tax implications of home ownership is like driving a car with your eyes closed. You are setting yourself up for a financial wreck, and that is a situation you are not allowed to be in. Understanding the different taxes associated with your home is not just about paying what you owe, it's about empowerment. It's about knowing where your hard-earned money is going and why. It is also about claiming every single deduction and benefit that you are legally and rightfully entitled to. When you fail to understand these rules, you are essentially leaving money on the table, money that could be in your savings account, your retirement fund, or paying down your mortgage faster. You work too hard to just give your money away because you didn't take the time to learn. So, you need to listen up, take notes, and take control of your financial destiny. The journey to financial security begins with knowledge. First up are property taxes. You cannot own a home and not pay property taxes. It is simply not possible. These taxes are the lifeblood of your local community. They are collected by your local government, your county, your city, your school district. They fund essential services you and your neighbors rely on every single day. Public schools, police, fire, roads, parks. Property taxes are calculated based on the assessed value of your home and the land it sits on. A local official, the tax assessor, determines this value and it can change over time. So, how much will you pay? It varies dramatically by location. The national average hovers around 1% of your home's value, but in high-tax states like New Jersey or Illinois, it can climb over 2%. In other areas, it might be lower. If your home's median price is, say, $416,900, you could be looking at an annual bill of over $4,100. Many homeowners pay this through an escrow account managed by the mortgage lender. Each month, a portion of your mortgage payment is set aside. The lender pays the bill on your behalf. This helps avoid a large lump sum payment once or twice a year. Next, we must discuss capital gains taxes. This tax applies when you sell your home for more than you paid. The profit you make is called a capital gain. For example, bought for $500,000 and sold years later for $1 million, your capital gain would be $500,000. Before you panic, you need to know about the primary residence exclusion. If you owned and lived in the home as your primary residence for at least 2 of the 5 years before sale, you can exclude up to $250,000 if single or $500,000 if married filing jointly. In our example, that $500,000 profit would be tax-free for a married couple. Beyond the main taxes, there are others you might encounter. Being surprised by them is a financial mistake you cannot afford to make. Let's talk about transfer taxes, a tax imposed by some states and local governments when a property changes hands. Usually calculated as a percentage of the sales price, often from a fraction of a percent up to 2%. In some places, the buyer pays. In others, the seller. Sometimes it's split. They are not universal. Texas and Florida often don't impose them. New York and California can. Next, special assessment taxes. They can appear on your property tax bill to pay for local improvements, new sidewalks, sewer upgrades, brighter streetlights, projects that directly benefit properties. These are typically one-time or short-term charges. Sometimes you can pay in installments. The amount depends on the project cost and your property's share of the benefit. Finally, the mansion tax for high-value homes. Sometimes a mansion is just a regular home in expensive markets. A one-time transfer tax on sales above a threshold, maybe 1M or 3M, depending on jurisdiction. States and cities like New York, New Jersey, Connecticut, and others may impose it. Rates are often progressive, typically paid by the buyer at closing. Factor this into your budget if you're buying high-end property. Now, for the part you've been waiting for, how to save money. The tax code provides several powerful deductions for homeowners. Honestly, you are approved to use every single one you qualify for. The most well-known is the mortgage interest deduction. It lets you subtract the interest you pay on your home loan from your taxable income, which can lower your tax bill significantly. The deduction applies to mortgages up to $750,000 for homes purchased after December 15, 2017. To claim it, you must itemize instead of taking the standard deduction. Another major benefit is the state and local tax SALT deduction. It lets you deduct state and local taxes, including property taxes, from your federal taxable income if you itemize. For years, it was capped at $10,000, which hurt homeowners in high-tax states. A 2025 bill temporarily raised that cap to $40,000 for many homeowners. Check the rules for income limits and phase-outs. Money spent improving your home can also save you on taxes. Major capital improvement, not simple repairs, count. You can add those costs to your home's cost basis, which reduces taxable gain when you sell. Example, bought for $300,000, spent $50,000 on remodels, adjusted basis $350,000, selling for $400,000 yields a taxable gain of only $50,000. Save every receipt, contract, and invoice for major work. It is your proof and it is your money. We have covered a lot of ground today. The single most important habit you can adopt is to keep meticulous records. You need a dedicated physical or digital folder for everything: closing documents, annual property tax bills, mortgage statements, and receipts for improvements. When tax time rolls around, you'll have everything at your fingertips. Know when to get help. Tax laws change, and your situation is unique. Consult a qualified tax professional. Keep good records. Ask for help when needed, and always strive to be strong, smart, and secure. You are the chief financial officer of your household. Take that role seriously. Thanks for watching. Like, comment, and subscribe. See you in the next video. Cheers.